What's up, guys? I'm Michael Key, investment advisor with EKC Financial Solutions. So, the other day, I had a video titled The Most Successful Strategy for the Stock Market. And in that video, I explained how investing in companies that are great businesses for long-term growth. Long-term is the most successful way to invest in the stock market. But when I say successful, I mean in terms of the long-term impact it has on your account. But what is the most profitable? And when I say the most profitable, for you to profit means that you have to realize those returns, right? So you have to have a open and a close of a position. So buying and holding for 20 years is not profitable until you close out the position in 20 years. So what is the most profitable? And not only what is the most profitable in the short term, but what is the strategy that has the best odds of being profitable? Well, as you know, if you watch the other videos, I'm damn sure not going to say day trading or chart reading or looking at the 200-day moving average or the RSI and seeing if it's over 50 or not, because it isn't. In fact, none of that stuff matters. I always go about, from an investment standpoint, the goal is to own assets. So in the case of the stock market, the asset would be owning the shares of the investment we want to own, be it Apple, Google, whatever. It could be an ETF, it could be a mutual fund, whatever, but we want to own the actual asset. And I know, in terms of it being tangible or intangible, you used to be able to actually hold the shares that you owned, that you would actually get the physical shares, but now they don't do that. They might in some certain circumstances, but for the most part, they don't. So it's just, you don't really feel that ownership, I don't think, anymore. But you do own it. And you do own those shares. And owning the asset is the best way to that's the end goal. But we know the number one rule of investing is buying low and selling high. Well, there's two ways you can buy low and sell high, or there's two ways you can control buying low and selling high. One of those ways you can't control. You can control how low you do buy in both ways. But one of those ways, the lower you go, the less likely you have a benefiting from anything. You're just waiting, and it may never happen. But the other way, you're waiting and waiting, but you're making money while you're waiting, while not owning the shares. And so the number one most profitable way, and before compliance even comes and tries to hit me on this, you could probably look it up on Google and it would tell you the same thing, is selling put options. And I'm even going to go as far as saying the bad word, selling naked put options. But it could be cash secured puts. It could be naked puts if you're in a margin account. If you utilize the margin properly as a disclosure, nothing on this channel is a recommendation. It is strictly for educational purposes only. So if you're doing the naked put options, which is different than cash secured puts, invest at your own risk and make sure you know what the deal is with the margin. But selling put options offers a great opportunity. It allows you to take advantage of arbitrage pricing because of implied volatility. But it also allows you to buy in to it lets you buy shares of a company you want to own or an ETF you want to own at the exact price that you want to buy it at, that you're okay with buying it at. So if, we're at all-time record highs right now in the stock market and you think Apple is a little too high for you to purchase right now, well, you could sell a put option and say, in a month I want to be able to buy it if it goes down to, if it has a 10% drop. And whatever that price, a 10% drop would be, you're going to go and find the put option strike price, and you're going to sell that option for a premium. And it could be, let's say it's $100 you bring in, you sell a put option for $100. You're going to bring in $100 cash into your account. And you're going to wait until expiration. And as you get closer to expiration, if Apple hasn't taken that backward movement yet, then that option is decaying and becoming worth less and less and less every day, which means that you're keeping more and more of that $100 that you sold it for. And if at expiration Apple doesn't go down to the price that you wanted to buy it at, you keep your full $100. You keep the full amount that you sold that contract for, which was the $100, and you don't buy the shares. So you basically made a $100 profit on putting a buy limit order in. Oh, but people say, oh, well, that's so risky. That's one of the most risky. No, it's not. It's actually less risky than buying the shares, because if you were going to buy 100 shares of a stock today at its trading price, and you bought at the market value, so if it was trading at $100 a share today and you bought 100 shares, you're going to pay $10,000 for the stock. And then it's up or down you go. Or you could sell a $90 strike put option expiring in a month for, let's say, depending on what stock it is, let's say for $150 or for $200. You bring in $200 cash. If the stock goes to $90, then you're going to purchase the shares at $90 a share instead of $100 a share like you would have today. So you saved yourself $1,000, plus you get to keep the $200 premium. So you actually saved yourself $1,200, and your cost basis for the trade is actually $8,800, so $88 a share, because you get to keep the premium you sold the contract for. If you put in a buy limit order for $90 a share, then if the stock goes to $90, you buy it at $90, but $9,000. So if you sold the put for $90, you get the $200 premium, which means your cost basis is $88 a share. If you did the buy limit, your cost basis is $90 a share. So you actually came out $200 ahead of the person that did the buy limit by selling that put option. And that is a great way to take advantage of, controlling what you're going to purchase the stock at. What are you giving up? Well, you're giving up any upward movement of not owning the shares, right? So if you're waiting on it to go backwards and the stock takes off and doubles, then you just make your $200 and you don't get all the upside. But if you look at the probabilities of that occurring, more times than not, that's not going to happen. And it's just, you just have to have that mindset that you're okay with having a higher probability of success with a limited upside. So you're going to get smaller gains, but you're having a higher probability of being successful. you're lowering your chances of loss, and you're lowering your overall risk on the trade, and you're giving up any potential upside. But here's the other argument to that, though, is that if the stock does take its, that drop, and you end up buying the stock at the price you wanted to, you keep your premium. Well, you've actually reduced the amount you bought it for, so you're going to get more of the upside if it does go up, because you're only going to do this on positions that you actually want to own, because like I said in the beginning, the goal is to own the physical asset at some point. This is just a way to position yourself a lot better into that asset. And what I'll even sometimes look at doing is the premiums that we keep that from the expired options, if it's enough, or once we get enough, we'll use that premium to just go and buy the shares at the market price. So maybe we buy, 1, 2, 3 shares, and we can grow our position by selling out of the money put options. And so basically our trade-off is we want to buy 100 shares or 200 shares, whatever it is. And now put option or any option contract is a contract for 100 shares. So you can only utilize this if you're actually wanting to buy 100 shares or more of the stock. But if we want to buy 100 shares, we're going to sell the put option out of the money at whatever price we want to buy the shares with. We don't care if the stock goes below that price. If it does, yeah, we'll be at a little bit of a loss, but we're at a way bigger advantage than if we bought the shares today. We saved a lot of that loss, but we're okay with purchasing the shares at whatever price we choose. We get our premium. Stock doesn't go down that far. It doesn't, and so we keep our premium. We're just going to turn around and if we got $100 premium and the stock's trading at $100, we just buy one share. And we just slowly build a position with the premiums that we're bringing in from selling puts that don't expire in the money. And again, this is going to be one that maybe hits compliance a little wrong, but I call it almost reverse financing. Because we're going to put up the capital up front. We're going to make sure that we have enough money and cash to secure this trade at the price that we want to buy the stock at. But we're going to sell this contract. Someone else is buying that contract from us. We're using their money to buy shares later on. Because when you're looking at it from an odds standpoint, you're basically, they're taking a gamble that the stock's going to go down, and you're taking a gamble that it's going to stay. It may even go down, but it's just going to stay above the price that you choose. So it can go down, it can stay the same, or it can go up. But as long as it doesn't go to the price that you chose, it's going to expire worthless, and you're going to keep the premium. And so you can actually dictate your probability of success. You can sell it further out of the money. You can choose, if it's a $100 stock, you can sell it at $60 a share for a put. You're just going to get a lot lower premium. You may get like $20, right? Less risk, less reward. But you have a higher probability of being successful. And if it goes down to, that far, then you're playing the odds of the stock. You're buying it at way lower price, right? Think of so last year with COVID, with the S&P 500, let's say, it went down where we have a 30% drop. Imagine selling put options, a put option that was like 20% out of the money, and you would have gotten hardly anything for it. And when the S&P fell, you're going to see this loss in your account. But you would see a lot less loss than someone who had bought the day before it started tanking. You'd see about a 20% less loss. But you also own the shares at a much lower price than you could have purchased them in the last couple years before that. So you would have gotten more of the upside when it came back. And when the market moves more, the premium on the options are higher because of implied volatility. Because people, think that it's going to keep moving the way it does, fluctuating. So you can actually sometimes get pretty good amount of money for these contracts. And some of you may not understand all this with the put options. Here's what I would say is I'm going to try and do some videos on it. Every time I try and I start drawing it out, in my mind, I'm like, oh, I'm getting too complicated. It's not as complicated as it sounds. And it's not as complicated as what people make it out to be, but it can be a lot because there are a lot of variables to it. So go and, and read about it. I think it's something that everyone should actually go and read about as options. Because there's a big misconception about the risk factor with options. But they're probably the greatest financial tool, in my opinion, that you have access to. And it's also one of those tools that I think most retail traders know more about than actual financial advisors. I think that the knowledge in the retail world, and retail means just everyday people that aren't licensed, that aren't money managers or, just day traders or whoever. They actually know a lot more, I think, about options and utilize them more than actual financial advisors because they have a lot more tools. A lot of advisors don't have the platforms to trade on like the Thinkorswims and stuff, but a lot of advisors they don't know. You'd be shocked. A lot of advisors do not know a damn thing about options. So yeah, I mean, if you have questions, please feel free to give me or shoot me an email. I'll have the link to my email below. Or go on our website and you can always reach out to me by phone. I can talk about options all day. I can talk about all the different strategies all day. But it all starts with, the teaching process of it. And getting a basic understanding of how they are. But if you can trade them for the tool that they are supposed to be used for, which means you're trading them to utilize the actual underlying investment. So you either want to utilize options to purchase the stock or ETF or to close out the stock or the ETF. Then you're entering into a very advantageous world in your investments. I would say that you have compound interest would be the 8th wonder of the world, and in my opinion, options would be the 9th. So, yeah, if you have any questions, I'd be glad to answer them. And I think maybe if you ask questions, it would help me in explaining them in future videos because it would give me, more of an idea on what I should cover and how to explain it. Because if I'm just going off the top of my head, I can go on and I'll only explain it in a way that makes sense to me, and that's not the way it needs to be explained to people that don't know anything about it. So, if you like the video, hit like. Don't forget to hit subscribe. And we will, keep this series going. And, yeah, thank you.